So just a quick look here. We're going to look at the bond yield. So what we just saw before was the Federal Reserve interest rate. What I'm showing you right now is the long-term chart of U.S. government bonds. The red line is the 2-year interest rate. The yellow line is the 5-year. The blue line is the 10-year, and the purple line is the 30-year. And so you'll notice, just like the federal funds rate, since the 1980s, it's been going down and to the right. But you'll notice that the purple line, the long-term interest rate, doesn't move as much as the short-term red one, right?
Mm.
So here, the purple one is the purple one is fairly steady here, right? Do you see that there?
I do.
But the red one goes down and up,
Gotcha.
right? Um, so then we have a difference between the red line and the other lines. And so when we take the difference between that, that's called the yield curve. The yield curve is the difference between short-term interest rates and long-term interest rates. So we're going to jump to the chart here, which is the yield curve. This is the difference between the 2-year interest rate and the 5-year interest rate. And it goes up and down. And this represents the business cycle. Now, people have made a lot of money on this chart, following this chart over the years, because when you get down to, actually, let me show you over here. So, do you see this red line now at the bottom of the screen?
Yes.
So, the interest rate, when it gets down to this red line, it means that when it crosses, it means that the yield curve has gone negative. That means that since this is 5 years minus 2 years, it means that the short-term interest rate is now higher than a long-term interest rate, which is squirrely. Like I told you
Mhm.
before, you would expect that the person longer term has a higher interest rate because they're saying, "Well, I'm taking more risk because I'm letting out my money longer, and so I need a higher price. You need to pay me more in order to get that money." But when financial conditions get so bad that lenders go, there's not enough lenders in the market, and the short term rates go above long term rates, that means there's a problem. That's an indication there's a problem in the system, right?
So normally short-term rates are lower than long-term rates because the longer you lend money out, the greater the risk.
So
So
when the
if
short-term
it's
rates get high,
short-term rates is higher, that means there's more risk for short-term?
yes, for some reason, the lenders in the short term are saying, "No, I'm sorry, you're gonna have to give me more now than later."
Oh
So
my
people go, "Wait,
god.
so it's better for me to borrow 5 years out than 2 years out?" Yeah, for now. And the idea there is that anyways, so
Has
as
this
you can
ever happened
imagine,
before?
it happens all the time. So whenever this yield curve here um, crosses down, whenever you see this blue line cross down past this red line, it means that's what's happening. That at that
Inverted yield
period,
curve. Hmm.
yeah, at that period, the yield curve has inverted, and there's a problem. In fact, it's so reliable that usually between 6 and 18 months after the first time the yield curve enters this red area, we have a uh, recession. I'm going to show you the recessions now on the chart.
Say that again.
And
16 what?
6 to 18 months after the yield curve goes negative, we usually have a almost like I think it's like a 90% accuracy or 95% accuracy that within 6 to 18 months we're gonna have a recession.
Hmm.
Oh, I should ask. Do you know what a recession is?
Yeah, a recession is when I go to the grocery
A
store
recession
and
is when you have 2 consecutive months of negative GDP growth. That means the
that's
growth
correct.
inside of the population in the country is negative for 2 quarters. This
Two
is bad,
quarters.
Peter. It means productivity is coming down. It means unemployment's is going to start going up. It's people are going to buy less stuff. There's less borrowing happening. It's
Great time to quit your job.
worst time to quit your job. Consider that to be the fall headed to winter, right? So as you notice here on the chart, do you see here the red bars behind these
Yes.
here? So those are recessionary periods. So in the we have the dot-com crisis over here in 2000. So right here in 2000, we have the dot-com crisis. We have the mortgage crisis in 2008. We have COVID in 2020, which is pretty interesting. Here, the yield curve inverted in January 2019,
Hmm.
and you're like, well, it inverted. How did it predict the COVID recession? Economic
This
data. Economic data,
is
aggregated
spooky,
economic
Tom.
data is super spooky. Exactly.
No, it's a coincidence.
Well,
How could it? How could it predict COVID?
well, we've talked about this in terms of the fourth turning before, that the an event can occur, and if that event had occurred, the COVID had occurred at the beginning, like we had come out of a recession and we're expanding, yield curve is going up, things are looking better for the economy. We would have absorbed that shock better.
I see.
But what it was indicating there is that the COVID shock came exactly at the wrong point. It came when things were already bad, and so it made the already bad things worse.
So, what do you think? If COVID didn't happen, would there have been something else that would have caused the reception? The recession?
Naturally, we would have already gone into a recession. Now, you have to understand, recessions and expansions happen automatically within any given system, right? So, the short version of this is this. So you have an economy, and then you have what's called a supply chain. And so that supply chain is all the way from growing things on a farm or mining things inside of a mine or what have you, and those base materials then get taken out from there, and they're sent to people who process it into oil, into different types of oil that are used for plastics and stuff like that. Processing food, processing wood into slats. Sorry, into slabs. You're processing that. You're cutting stone. You're preparing that. Then that goes off to the producers, people who actually produce that and turn it into jewelry, turn it into chairs, turn it into what have you. Who then sell it wholesale to retailers who stock up, and then they sell it to you at the store, right? So
This is a
that
supply
is
chain. Is that what
the
you're?
exactly. This is a supply chain. And so what happens is that that whole process can take 6 to 18 months. And so what happens is that if there's a problem, let's say there's less lending happening. Let's say for some reason there is well, there's all kinds of ideas that come to mind, but let's say there's a problem with lending to the people at the beginning of that chain. The new miners can't get enough money to. Um, Actually, let me put it in a different way. At the end of the chain, the retailers and wholesalers have inventory stock that they've purchased, right? And so the retailers might have hired a bunch of new people in order to sell the stuff, right? They hired more restaurant people, they hired more laborers inside the factories or what have you. They hired more people in order to sell this inventory or to provide these services. Well, at a certain point, the number of people in that cycle who are going to buy those products, they've bought it already, right? They bought the
Mhm.
chairs, they bought the new beds, they bought the what have you, and so the rate at which they're buying slows down. And as the rate at which they're buying slows down, the profit margin of the retailer or even the wholesaler decreases, and they might still have inventory, right? And so then they start laying off people or not hiring people at the same rate, and so unemployment goes up, and then it keeps going until so now they're no longer ordering new inventory to replace the inventory that they're selling. They've stopped buying inventory from the wholesaler, right? And so the
Mhm.
wholesaler has stopped. Um, uh, their orders to the producers have also gone down, and then those producers say, "Hey, wait, we don't need as much materials," and so mining goes down and growing goes down. It slows it. It's the slowdown goes up the chain, right? Then it goes. Usually, what happens with people is that they literally extrapolate, and then um, they stop ordering too much, right? And so what happens is that then
You mean they overcompensate?
they overcompensate exactly. They overshoot it. And so it slows down more than it necessarily must because it's just this momentum of decrease in sales and inventory purchasing and growing and all that sort of thing.
Mhm.
So then what happens? What happens is at a certain point, the inventory that the retailers and wholesalers have built up gets depleted, right? And as it gets depleted, so as supply comes down, so the demand came down first. So as the demand comes down, um, uh, the uh, the price has to lower, right? And so at a certain point, the price comes down to a point where it matches demand. And then now the demand starts to increase. And as the demand increases, there's not enough supply, right? And if there's not enough supply, well, then the price starts going up for those goods and services. And as the price keeps going up for those goods and services, other people who can make those, provide those goods and services start doing that. And so they start putting in orders. Hey, we need more of these chairs. We need more of whatever it is, and they send up the orders down the supply chain or up the supply chain, and then the wholesalers do more. The producers, the growers, all the way up to the base materials, and so they start overcompensating the other way. Oh, let's make as much as possible, and then this starts again. So the inventory cycle, how much inventory, which is one of the metrics that you can follow in the economy, tells you gives you a nice indicator for what might happen 6 to 8 months down the line, and it's the trend of it, right? It's the trend of what is the ebb and flow, what is the rate of change of the inventory for any given industry.
And is that
That
the
makes
business
sense.
cycle?
That is the business cycle, exactly.
Well,
And
so
so if you
if you
pay
had a
attention to this, you can
central,
make money.
you could what? You can make money, you said?
There's people who make money off this inventory cycle, right? They can see this ebb and flow, and if they have a specialty in any particular industry, they know when to buy things low, when to buy things high, how to cut a deal, and take advantage of this, or to buy stocks in companies that are at the bottom of the business cycle, because they know, well, over the next period of time, over the next uh, 18 months, a year, 18 months, that the stock for this should go up as more people are purchasing products from this company. Their earnings will increase, and so just like that, you can earn money 5 to 7% per year just following the inventory cycle.
It seems to me that if we had a central planner, they could get rid of this business cycle, smooth everything out, stop with this overcompensating and this supply and demand thing, and the prices would just stay stable for the rest of our lives, Tom.
So enter the central banks, right? So the history of the central banks is long and storied. I'm not going to go into all the details about that. You can read a book called Lords of Finance. Very interesting. Well, very extremely boring if you're not interested in the history of the central bank. Super dry, super dull. But if you are,
Extremely boring almost sounds entertaining. Like, you know what I mean? If you somebody told me this movie is extremely boring, I'd be like, I gotta see this movie.
well, it's very insightful, and you're not going to find a lot of books like that. So it's really pretty cool.
Lord
But
of.
if eventually the central banks came to the conclusion that what they can do, well, what would happen is that I talked about that inventory cycle as if it's nice and easy, but shocks to the system can really destabilize it. And one of the shocks that would happen is that you would get these bank runs, right? So people would be like, "Oh, I'm not sure what happened. Something, let's say something like COVID happened, or it doesn't have to be to that magnitude, but any shock within a given population, and it really disrupts the inventory cycle, and it disrupts credit, and it disrupts people's trust in banks or what have you. And then you would have these runs on banks where people go, "Oh, I need to take all my money out," but the bank doesn't have all that money. The bank then collapses, and then the economy in that given area goes down, because where you're going to borrow money from if not from the people who have money, because they don't have any money
Isn't that what
anymore.
happened during the Great Depression?
No,
Oh,
the
never mind then.
Federal Reserve caused the Great Depression, but let's not.
Blasphemy.
A number of reasons, but before that, before the central banks were around, you'd have bank runs and then collapses, and if one or a couple of banks in that area fell, I mean, you see, no, it's a wonderful life. It can really destroy a town. The panic can really destroy a town, and so the central banks decided, well, they can guarantee the money in the bank, right? So if there's not enough money, they could send money there, and they could insure the deposits at the bank, and so you didn't have to really worry that your money was going to disappear, right? It used to
Mhm.
be that choosing a bank was like trying to choose which cell phone you wanted to use. You'd really have to think about what are the features you wanted, what are the risks, how long term will they support this, blah blah blah. But then it became more just a utility. You now we feel comfortable just going with any bank because it's guaranteed by the government to a certain amount. Not a good idea, but whatever. That's what people do. So central banks decided
Sounds like
if
a great
they
idea to me. Sorry, go ahead.
Central banks decided that if they, by modifying the interest rate and modifying the amount of money flowing inside the system, they can, on an expansion up, continue that expansion, and on a dip, they can, when they saw a recession, they could, compensate for people the momentum by sending signals to the market that, oh, things are better than they thought. So then people would spend and borrow more money than they would have otherwise. And so that's how you end up in this thing. I mean, it would work fine if it's sort of like, if you have a credit card and you spend the money on the credit card and you pay off the credit card, then that's fine, right, Peter?
Mhm.
You spend the credit card, you pay off the credit card, and you use it when you need to. Great. So that it can make you good times better and can help you in bad times by having a source of capital. If you spend the money on the credit card and then you take out another credit card in order to pay the interest on the previous credit card, and you keep doing that, well, Peter, it seems like you have tons of money, doesn't it?
Free money, baby.
Free money. You're like, tons of money. I just had getting new credit cards, and I could always get a new credit card because the next credit card, the interest rate will be lower than the one before. And if I just keep getting credit cards with lower interest rates, I could keep paying off the debt that I've accumulated. Well, we all saw what happened in the subprime mortgage crisis in 2008 when you have just a series of dominoes of debt. Anyways, yield curve. So this squiggly line is going up and down and up and down, represents the business cycle. So when the, like I said before, when the line is going up, it means that more money is flowing into more lending is happening, and so more money is being created. Remember, the spread between the short term and long term rates is increasing, and when it comes down, it means things are headed towards badness until it inverts, crosses the zero, and then 6 to 18 months after that, you usually have a recession. Right? We
I
overlay
understand
that with
completely.
the. Ooh, 1 second. Let me just take these guys. We overlay that with the federal funds rate. And you'll notice that the federal funds rate in general is the inverse of the yield curve, right? So
I can
interest
see that.
rates,
Yeah.
right? So when interest rates are falling, remember we said that when the Fed funds rate is falling, it means financial conditions are what?
Say that again.
Loosening. Loosening, exactly. When the Fed funds rate is coming down and they're cutting interest rates, it means that the financial conditions are getting looser, right?
Yes.
Because the spread between the short term and long term is getting wider to encourage lending, right?
Oh, I
And so the yield
understand.
curve
I
goes up.
understand. Yeah.
Perfect. Now, let's take a nice little notice over here that before, between 1989 and 2008, it was basically just completely inverse. Let me actually flip this so you can see. I just flip it. They match, right? The yield curve and the federal funds rate. But as of 2008, after the global financial crisis, where the world changed,
Wait, I'm sorry. Hang on. The yield curve is the difference between the long term and the short term
exactly.
interest rates. And the other thing you said was the funds rate. And
The
what's that
federal
again?
funds rate is the interest rate set by the central bank of the United States. And they're trying to modify the short term rate. So when they're increasing the federal funds rate and it's going higher, they are shrinking the difference between the long term and short term. They increase interest rates to shrink that spread to make people borrow less money, to
Gotcha.
slow down the system.
And they're
And when
not forcing the situation, they're not setting it, but they're influencing the market because they're a major market player.
exactly, they're pretty much forcing the short term.
All right.
Not fully, but pretty much. And what's interesting on this chart here is that as of 2008, you see how 2008 the yield curve, sorry, not the yield curve, the federal funds rate is 0% basically. That means the cost to borrow money for large players was zero or near 0%. What does
Wow.
that mean, Peter? What does that mean for financial conditions?
It means it's loosey loosey.
Super loose, super loose. And so Tons of money was sloshed around the system. And in fact, this period from 2008 to 2016 was the longest period of expansion on record for the United States. Just
Hmm.
massive amount of money being pumped into the system.
Just keep
And we
that
notice
going,
here,
man.
sorry?
Why don't
Well, they
they just
tried.
keep that going?
Well, they tried. So notice here how the yield curve peaked over here in 2010,
Hmm.
and it was coming down. So this coming down over here was headed towards a recession, right? Once across this line, we would have had a recession 6 to 18 months later.
Hmm.
But something happened over here where it was averted and the line started going back up, right?
Hmm.
Enter the third thing that modifies that we're going to talk about that modifies financial conditions, which is QE, quantitative easing.
Yeah, boy.
All right, Peter. So give me the dictionary definition of quantitative easing. Go.
Quantitative easing is
Quantitative
the
easing is
euphemism.
when the Federal Reserve, in lieu of cutting interest rates because they were already at 0%, they can't cut it anymore unless they want to go to negative interest rates. And we saw what happens out of Europe when you go to negative interest rates, where you lose money if you save money. What they would do is that the Federal Reserve, through all kinds of different machinations, would actually buy debt off of banks' balance sheets. They would buy debt. They would buy the debt because, as you can imagine, a bank needs to have. They can't just lend out an infinite amount of money, right? They
Mhm,
When you deposit money at the bank, they have access to that gives them ability to give out loans because on their balance sheet they have an asset, but they're constrained. There's a certain amount of a ratio between the amount of assets that they have and the amount of loans that they can give out. They have to have what's called a reserve requirement, that this is the amount of money that they should have on hand or assets on their balance sheet in order to be able to lend out X amount of money. And so, in order to encourage banks, because they couldn't cut interest rates anymore, in order to encourage banks to lend out, what they would do is that they would buy liabilities, or not liabilities, they would buy assets on the bank's balance sheets that don't allow them to lend out more money. Like this was just assets that they have, but it wasn't anything you could lend against. They would buy that, put that on their balance sheet, the Federal Reserve on their infinite balance sheet, put it on, and buy it with empty money, just new money. They would just buy it from the balance sheet of the banks, and now they have what's called a reserve asset. It's like money that's only good in that it allows banks to lend out more than they otherwise could have. Does that make sense?
makes sense. I mean, doesn't make sense, but it makes sense.
Well, the Federal Reserve is just buying it with what? No one knows.
That's the part that yeah.
Exactly. So that's the idea of money printing, right? Quote unquote money printing. It isn't really money printing in that way because the money that's being put inside of the banks can't go out and buy gas with it. They just can't go buy anything with it. It's just there to allow them to lend out more than they otherwise could have. That's it, right?
Right.
And so what happens is that on our chart over here, you'll notice that once so over here, where we were headed towards a inverted yield curve and then eventually recession. Money is printed into the system over here.
And this money printing quantitative easing started in 2003.
It started in 2008. Well, it really started in 2003, but it really picked up in 2008. But anyways, it really started in 2008. That's when
Well, talk
quantitative
about
easing
picking
started.
up. So they had to do that because of the financial crisis. I
They
see it
had to do that
shooting up
because they
there.
cut interest rates all the way down to zero, and so they couldn't cut interest rate anymore in order to stimulate economic
But
growth.
why did they feel they needed to stimulate right then? That's not during the crisis that Obama had to deal with?
Yes, I mean they feel the need to have to stimulate because the world's in a recession, and so
Oh,
our economy is based on consumers. Like consumers have to buy in order to, or actually, consumers have to borrow money in order for new money to be created in the system. We're a credit based economy. Um, What's the
I get
simplest
it.
way of putting this? Yeah,
No, I
so
get it.
if people don't borrow money and spend money, then there's no churn within the economy, and if we have a slowdown in that for too long, then we end up in a crash because the loans get defaulted on, and when loans get defaulted on, Peter, it's like that money and all the money tied to it that was created from the spiraling out of that, the pyramiding of debt disappears. So you actually get the money supply shrinking, right? And that's deflationary, or what they would call disinflationary. So that's bad. The Federal Reserve wants more money flowing around and assets to go higher and real estate to go higher and stocks to go higher. Why? Because it causes money to from outside to pour into the United States. The better your assets do in your country, the more outside money pours into it.
Sounds like you're making the case for money printing go brrr,
Well,
brrr.
they certainly make the case for it. And so you'll notice here on the chart, while rates are federal funds rates are at zero, they keep buoying the economy. But you'll notice that the highs get lower, right? Lower highs means that the money that they're putting in is not doing as much as it did before. So it's a ticking time bomb. Eventually, they're going to put money in and it won't do anything. But that's neither here nor there because that's not what we're talking about. We're not talking about the eventual collapse of the financial system, which will happen and is scheduled for some period within this tribulation or fourth turning. But what is interesting is actually let's take a look at how this reflects with the stock market. So the S&P, you know what the S&P is?
The
The
S&P.
S&P 500 is an index of stocks of the larger stocks that are publicly tradable on the U.S. stock market, and so it's a nice proxy for how the market in general is doing. It includes tech, it includes energy, includes commodities, it includes a bunch of different things in a smatter of different things. The big players in that space. And so you'll notice here on the chart, I'm showing the S&P in white. So the S&P, it's been climbing. Basically, it's been going up and to the right ever since the stock market, the data we have here since the 70s, but ever since the stock market was open. But we have these ebbs and flows. This peak over here that we're seeing was the dot-com crash. Over here, this is the crisis, the global financial crisis. Over here, this is Brexit and the Greek debt crisis. Over here is COVID. And oh, look at this. Looks like something is rotten in Denmark.
Oh no.
That's right. So the question is, what's going on over here? So,
So this is one of those indicator things where, we talked about the market. The reason we like these charts is that it kind of gives you signals and predicts. These are market indicators that can kind of predict the conditions that are to come. So when we look at this little dip here at the end of this white line, it which is indicating a drop, a recession is coming. This is why a chart like this is useful for you.
exactly. So you've probably heard people talk a lot about buy and hold is the best strategy when it comes to stocks, right?
Buy and hold.
Yeah, they're like, oh, don't trade, buy and hold the stock.
Oh yeah, because
Uh,
you buy it and it goes up,
it
guaranteed.
goes up and to the right.
Yeah.
Yeah, that's true, depending on where you buy it, right? So let's go back to the chart over here. If you take a look at the stock market, if you bought the Nasdaq, sorry, the tech stocks at the height of the dot com bubble, anywhere between 1998 and 2001, if you bought here, well, it took you until 2008 for the prices, 2007, 2008 for the prices to get back to where you bought it before.
Was that 9 years, 8 years?
Exactly. So that's 8 years. That's pretty garbage, right?
Hmm.
Obviously, if you bought it over here in 1994, then you're happy, right? Even if you sold it at the lowest point of the dot com crisis, you still made money. Now imagine the guy who buys stocks over here, or the generation who buys stocks at the top over here in 2000. They have to wait till over here, 2006, 7, 8, to get back to break even, right? And we know that break even is not even break even, Peter. because $100,000 in 2000 doesn't buy the same amount as $100,000 in 2008. Even just in counting inflation, right? Inflation is the rate at which the money supply increases. And so, if your or what your money buys now versus what it did before, and so let's say, for the sake of our argument, we take the government data and said inflation is around 2%, right? Or that's what they're targeting, 2% inflation. Well, that means if you hold $100,000 in your bank, by next year, it can only buy $98,000 worth of goods, right?
Right.
And that's compounded per year. And so the if you bought stocks at the top of the dot com bubble, and then you're like, okay, I'm back to break even at the right before the mortgage crisis in 2008. Well, you're not at break even. There's inflation every year. So
Hmm.
your money's even less. So that you're in a poor situation. And then let's say you still bought, you still held, and then the stock market dropped again. Well, it was only in 2013 that you got back to break even.
Oh my God.
So the person who invested, their retirement or their nest egg or whatever investment they put at a dot com crisis near the top, it took them until 2013 in order to make their money back. Oh, not even, just to get to nominally break even and not really even break even because of the inflation. In fact, it was actually a little bit later on in 2016 that they would even been in break even territory. So buy and hold, I mean, it frustrates me when I see YouTube videos that people go, "Oh, just buy and hold the index stocks," and you go, "Okay, but when?" It's like people telling you to plant your crops in November. It's like, now's not the time. All right,
But if you don't
buy
know
and hold
these
until
charts,
the
then
right
you
time.
don't know when the right time is.
Exactly, super super useful to know that. And so you'll notice over here that the um, let's take a look at over here. So we see here in from 1993 all the way down to 2000, the blue line is going down and to the right, right? And the blue line coming down means that financial conditions are tightening. This is the yield curve, right? The financial conditions are getting tighter and tighter and tighter and tighter. We see that it inverts here in 98, and then 18 months later, stocks crash, right?
Hmm.
So the idea is that if you bought stocks before, you would just every now and then, every month or so, pay attention to the yield curve, and when you saw the yield curve invert, right? You would wait a certain period of time, wait a few months for the momentum to sort of continue, and then you would sell your stocks. You would just sell.
Hmm.
And you go, oh, but Tom, what if the stock market keeps going up after that? Okay, that's fine. Then you miss out on those gains. But what happens if it goes down? Right? That's what you want to guard against.
And the game in the
Uh,
stock market is not about how much you can make; it's about how much to not lose.
exactly. Same thing over here again in 2000. The stock market bottoms in 2003. Financial conditions were started to tightening over here again. So the blue line's coming down, right?
Hmm.
And then the yield curve inverts over here in 2006. So the idea is that, okay, great, it inverts, don't panic, right? You'll notice here that every time it inverted, the stock market panicked like that period for that period of time. It
Hmm.
inverts over here, and the stock market is panicking here, even over here. Don't do that. Don't panic as soon as the information comes out. Wait for the momentum to cross. You'll notice here that after it inverts the first time, it usually needs to invert again afterwards. It goes deeper negative, right?
But you've told me you've told me in the past, if I remember correctly, that you don't want to try to time the peak because you will never get it, and if you do, it's luck.
Yeah. So what you do here is that maybe on the first inversion, you sell half your position, half the assets you have, or whatever. I'm just saying you don't overreact because in August, 2 weeks before the end of August, it got cold for a little bit.
Hmm.
You go, okay, right. This reminds me that winter's coming and that I need to actually pay closer attention week by week as opposed to month by month or quarter by quarter. That's all I'm saying here.
Gotcha.
You can't time necessarily the day, but it gives you I mean, so far, aren't you seeing that it's giving you a pretty general indication of what to look for?
Yeah.
Again, over here in before the mortgage crisis. You've probably seen the heard about the movie The Big Short, and people who had made money on the collapse of the system because they were paying attention to stuff like this. They could see that the yield curve inverted over here, right? But if the yield curve inverts over here, and this is when you sold your stock, or this is when you panicked, or this is when you shorted the market, or whatever, there's tons of people who lost tons of money as the stock market kept going up. If you
Mhm.
watch The Big Short, you'll see that it was a Michael Burry was like bleeding millions of dollars, millions and millions of dollars as he was waiting for this collapse to happen. He went too early, right? So then the stock market rolls over and falls again. And then we see the same thing over here. Last time it inverted, the stock market, the yield curve inverts. That's not the time to leave, right? We have a panic here, what's called Volmageddon. Anyways, neither here nor there. Very interesting point in the financial history, but we have a dip, and in this dip, you could have panic sold, right?
Mhm.
Right? Not necessarily the best idea because you know that this momentum that carries, and the time to get out of it was the second time, or as it inverted again, and this would have been the perfect time to get out, right? And then
Tippy
boom,
top.
recession happens. And so right now, we are headed again towards this line. We see that the yield curve is headed towards that line.
When you say headed, it looks like it's dropping off a cliff.
Yeah,
Are
it is
we
dropping
not
off a
there?
cliff.
What time is it? Are we there yet?
No, not yet. I mean, pretty soon though. Pretty soon we're gonna get there. But don't over here, the person who thought that the yield curve was headed to negative and now it's time to short would have been way too early, right? Sometimes
Mhm.
you can get a bounce in the yield curve.
You want
You
to
don't
wait
want to
till
be
it
too early.
crosses the line the first time.
You actually wait. You actually wait till it gets down there.
Not financial advice. Just going to
Not
throw that
financial
in
advice.
there.
I'm
There.
just saying that's what I would pay attention to. All right.
Yeah.
All right. So, what does this have to do with Bitcoin? Well,
What does this have to do with Bitcoin?
let's take a look at a Bitcoin baby.